If you invest 50 lakhs in a property, how much rent should you actually expect? 3%, 5%, or 10%? Many people buy property for investment, but they never calculate the actual return they are getting. Today, I'll explain the global benchmark for rental income that investors around the world use before buying any property. And by the end of this video, you will be able to calculate yourself the return of any property. Let's look at what is rental yield. Across the world, the real estate investors use a simple concept called rental yield. A rental yield tells you how much income a property generates compared to its price. The formula is simple. Rental yield equal to annual rental income divided by property price into 100. Let's understand this with a simple example. Suppose you buy a property for 1 CR and the monthly rent of that property is 30,000. First, calculate the annual rent, which is coming around 3,60,000 per year. Now we calculate the rental yield. 3,60,000 divided by 1 crore into 100. The result is 3.6% per year. This means your property is generating 3.6% rental return annually. Global benchmark for rental return. Now, the important question is, what is considered a good rental return globally? Globally, the average residential rental yield is generally around 4 to 6% per year. This is considered a normal and stable real estate investment return. If the property is generating 6% to 8% rental yield, investors usually consider it a very strong investment opportunity. Anything above 8% is considered a high rental yield property. Now let's look why rental yield matters. Many people only focus on property price appreciation, but smart investors also analyze the income potential for the property, especially when you're buying a rental property. A rental yield helps investors understand three important things. First, how quick their investment can recover through rental income. Second, how stable their income will be in long term. Third, whether the property is overpriced or undervalued. For example, if a 1 crore property generates only 20,000 rent per month, the rental yield becomes only 2.4%. That may indicate the property is overpriced from an investment perspective. Let's take an example from Indian cities. If we look at Indian cities like Hyderabad, Bangalore and Mumbai, residential rental yield generally ranges between 3 and 6%. Cities with strong job market, IT growth and infrastructure development tend to have better rental demand, which supports rental income. This is why many investors prefer such markets for property investments. The simple investors rule. Professional investors usually follow a simple rule when evaluating rental income. If the rental yield is below 3%, it is considered a low income property. If the rental yield is between 4 to 6%, it is considered a stable investment. If the rental yield is above 6%, it becomes a strong income generating assets. So before buying any investment property, always calculate the rental yield. Conclusion: when evaluating a property investment, don't only ask how much does this property cost. The important question you should be asking, how much income will this property generate? Because smart investors don't just buy property, they buy income producing assets. And this is exactly how investors around the world evaluate real estate. If you found this video helpful and want to learn more about real estate investing and property returns, make sure to subscribe to the channel. And if you like me to explain how to calculate ROI for land investments or plots or flats, let me know in the comment. I will make a detailed video for you as well.